Hello and welcome to the Print Macro Sutra. I know a lot of our regular viewers and even the viewers who used to come to us for our economic shows have been missing us for some time. We took a break and we've launched this new show, Macro Sutra, with Radhika Pandey. Radhika Pandey is one of India's bright young economists. She's a senior fellow at the National Institute of Public Finance and Policy. Her research interests include business cycles, capital controls, financial sector regulation, and she's also a regular columnist. In fact, you would have read her name with the columns we published in the past with Professor Ila Patnaik. So she's not a new name to the print, but she's new on video, and we have a new show for her called Macro Sutra. Welcome, Radhika. Wonderful to have you on the show.
Thank you.
You've been writing for us, so now it's a wonderful opportunity to get you to speak to our viewers. And there are a lot of young viewers who look forward to getting the economic analysis we do every week. So please tune in. This week, we're talking about the only one subject that there is to talk about, and that's inflation. You must have been reading all the headlines about soaring sticky inflation and the fact that the government is going out of its way to try and curb it or fight this sticky inflation through various measures. My first question to you, Radhika, and you've written this column this morning about the steps that the government is taking to control inflation. The link will be in the notes of the show for people who want to read. First of all, for a long time we have been saying that this inflation is imported inflation, much of it, and it's a supply side inflation. And because it's imported inflation, there is very little the government can do or have control over. So were you surprised, or have you been surprised with all the steps that the government has announced, whether it's fuel, taxes, excise duty on petrol and diesel, reduction in customs duty on some things, and then banning exports of things like wheat? Have you been surprised that the government suddenly, does it feel like the government panicked, or there is a bit of panic about inflation?
So if we look at the composition of inflation, so if we see the CPI and the WPI, CPI was primarily driven by fuel prices. So we saw that on May 4th, the Reserve Bank of India hiked the repo rate, and there were expectations that the monetary policy measures could be followed by some fiscal intervention. So to take into account, if we look at those factors, it was not surprising, it was coming, and some of these measures were enacted to give some kind of relief to common man, because if we look at the composition of inflation, rural inflation was much higher than urban inflation. That means that fuel inflation was hitting the common man the hardest. So the government tried to intervene by cutting import duties on petrol and diesel, and to provide some relief to farmers. They have doubled the subsidy on fertilizers. So these measures were expected, and especially when the Reserve Bank of India hiked the repo rate, there were expectations that just the monetary policy measure would not suffice, and the government should also take some fiscal interventions to provide relief to the common man and to cool inflation.
So Radhika, do you think these steps will actually work?
To some extent, yes, particularly the reduction in import duties on petrol and diesel, because as I said earlier, one of the prime drivers of inflation, CPI inflation, WPI inflation, has been the fuel inflation. So if we cut the excise duty on petrol and diesel, it would have some impact on CPI, though not a very large impact. It would have, say, 0.2 to 0.3% moderation in inflation, but at least there will be some cooling off from the record highs that we saw in April. It almost touched 7.8%, which was an 8-year high. So we will see some moderation. But at the same time, the point worth noting is that now inflation has become much more broad-based. It started with food and fuel inflation, but now if we look at the other components of CPI, if we look at services, we look at clothing and footwear, we look at personal care, all these components are showing touching double digits, 8%, 9%. So the impact of these measures would be to some extent, to help in cooling inflation. But still, inflation is likely to remain elevated, and it will be above the, the comfort band, the upper threshold band of 6%.
The one other fuel we forgot, although it's wrong to call it a fuel, edible oils.
Yes.
They've taken steps there, but edible oil prices have soared like nothing.
Yeah. So if we look at edible oil, because of war, there have been disruptions, and then Indonesia imposed a ban on export of palm oil. So as a result, we saw a sharp spike in edible oils. So the government has been taking steps to curb, reduce duties on edible oils, on basic duties on sunflower, on crude palm oil, and so on. So there would be some impact, but again, the global headwinds are so volatile and the situation is still unfolding. So these measures won't be an end itself. We can see some more measures going forward.
That is what you say, and that was my next question, that there will be some more duty cuts probably in the coming days and weeks. But you also talk about fiscal implications, and it is going to dent the government's plans for this year, and I don't know whether the fiscal deficit target will be breached.
Absolutely. That is a cause of concern because, on the one side, these measures will help in cooling inflation to some extent. But on the other side, the government's fiscal deficit target of 6.4% comes under strain due to these measures. So it's not just these measures. Even before this, the government announced the extension of the free food grain distribution scheme. That has additional fiscal implications. And then this duty cuts on petrol and diesel will have an additional fiscal implication of 1 trillion rupees. Fertilizer subsidy another. So we are seeing at least a deviation of 2.5 to 3 lakh crore over and above the announced market borrowing. So there are indications that fiscal deficit could be deviated. The positive point here is that the tax revenues have been quite buoyant, and if we look at the budget projection, they have been quite conservative. They have been even below the revised estimates of last year. So if we go by those measures, we should see actual tax receipts surpassing the budgetary estimates, and to some extent the deficit, the gap or the deviation being bridged. But it all depends on to what extent government takes additional measures. But as of now, the government sense is that through revenue it will be able to bridge its gap.
In fact, revenues have been surprisingly good. We see every month the GST numbers are breaking records, and experts have also said that the government has been conservative in talking about its tax revenues last year. So they will probably do better than what they have mentioned. So that is the positive side of revenues. But these measures, Radhika, is sort of, there are possible unintended consequences because there is some distortion. It affects the market, it affects plans of farmers, it affects plans of traders. People we read about how there were loads and loads of wheat containers waiting to be exported, but they could not be because suddenly the ban came into place. So it's a bit of a complicated, confusing situation for people who are dependent on exports and growing wheat and sugar grains.
Yeah, absolutely. So on the one side, the import duty cuts have happened, and on the other side, the government has hiked export duties on steel, on iron ore. So that measure has really, dented the possibility or the prospects of steel producers to further expand their productive capacity. Because what we saw last year was that metal prices have been skyrocketing. So we have seen steel producers expanding their capacity over the long run, especially in 2021-22. We saw them, exporting taking advantage of the rise in international prices. But now when exports are disincentivized through the imposition of export duties, then their entire plans get disturbed. And we have already seen some of the steel manufacturers making an announcement that they will now reconsider some of their capacity expansion plans. So on the one side, we see that government is giving impetus to private investment, convincing them to expand their productive capacity because government is increasing public capex, so creating a kind of a investment congenial for private investment. And on the other side, we see export bans disturbing the calculations of and the long-term prospects of the capacity expansion plans. So these do create a kind of inconsistent policy environment. That's on the export front, and also from the farmers' point of view also. What we saw last year was that India achieved a record agri exports of USD $50 billion because of the export promotion measures. And again, the farmers were taking advantage of the rise in wheat prices. So if we look at the international wheat prices, were at least 15% higher than the minimum support prices. So we saw that farmers were taking advantage, and now because of this export ban, again there's this kind of break on the prospects of farmers to earn higher income. But at the same time, what we see is that India is not the only country doing this. If we look at the International Food Policy Research Institute tracker, we see that as many as 14 countries have imposed these kind of restrictions. So it is kind of, because of this kind of situation that we are facing, politically this has become a very convenient tool to first safeguard the domestic interests and to insulate domestic prices from international prices. So there is a kind of a conflict and a policy trade-off, but that is happening across the world.
Yeah, but would you say that this inflation we are seeing now, because last year we all said it's supply side, and once the supply side gets fixed, it gets taken care of, but the war really affected all those calculations. But now this war is going on for 3 months now. It started in the end of February. We are in about in the end of May. Will it cool once monsoons come for us and domestic supplies improve, or do you see this sticky inflation lasting through this year, because nobody is unable to plan for the rest of the year?
Absolutely. So it's all depend on the the trajectory, where the war goes, how it unfolds, whether the war it comes to an end or it continues for longer. Because if we look at most of the inflation that is happening in India, it is imported inflation. We talk about edible oils, we talk about fuel prices. These are all supply side disruptions. And at the same time, there's another factor that needs to be considered, is that now most of the central banks have started tightening their liquidity. So as a result, FPI, the foreign investor money, is flowing out of the India's market, which is causing further rupee depreciation. And when rupee depreciates, our imports become more costly. So as it is, they are costly due to supply side disruption. And then there is further pass through of exchange rate. Exchange rate depreciation makes our imports more costlier. So it is very volatile. It is very uncertain situation. And it's all mostly driven by global headwinds. And the other factor, what we are seeing is that because COVID has receded, or it's almost, it's on the verge of, receding, we see that services sector have opened up. Contact intensive services, hospitality, travel, these sectors have started opening up. So as a result, the input cost pressures are being transmitted to final consumers. So that is another source of inflation. So one is global headwinds due to edible oils and crude oil and fertilizers. The other is that within the economy also, because of opening up, the demand has started picking up. So that now there is a combination of both supply side driven inflation as well as to some extent demand side inflation also. And therefore the Reserve Bank has made it clear that going forward they are going to raise interest rates, because now it's not just supply side, it's also now transmission of input cost pressures to consumers, demand picking up. So these factors are also contributing to inflation.
One of the commodities that's made the most news in all the commodities we've discussed has been wheat. What is your take on this decision to ban wheat exports?
So again, it's a very complex policy decision. On the one side, we have to look at the situation on why this happened. Because of the heat wave, we saw that the wheat crop was damaged, and whatever the government had initially put up its projections of wheat production, they were not. They had revised downwards by 4 to 6%. So because of heat wave, and then due to procurement also not happening, it was less than half of what has happened last year. So due to these two factors, there was this kind of a panic situation that the government would not be able to meet its commitments under the free food grain distribution. So, and there could be food insecurity within the country. So as a result of these two factors, this decision to ban exports of wheat was taken. But as I said, economically it's not a very prudent decision. And empirically also, if we look at, there have been various reports and studies on countries that imposed this and whether it helped in cooling the prices. It actually didn't. So if we look at, Russia did it in 2010. They banned wheat exports in the hope that domestic prices of wheat will come down. But that didn't happen in the short run, because farmers were hoarding in the hope that prices will rise or this export ban will be taken back. So it is questionable whether it will actually lead to a consistent decline in prices. But on the other side, the flip side is quite clear. It dents the credibility of the economy as a supplier of food. You lose an export market which you could have had. So, and it's very hard to again get the export share which a country loses, be it in steel or be it in wheat.
We'll take some questions from our viewers, Radhika. We will stick to the topic. I know a lot of our viewers are sending questions about a lot of subjects. There are a lot of issues right now which we are looking for answers, but we try to stick to our topic. But we will take other topics keep coming up, so we'll deal with that. The question, first one I would like to pose for you, Radhika, is from Vedant. Please help me understand, how is stock market reacting to inflation numbers?
So stock market is also adversely reacting to inflation numbers, because what happens is that when inflation rises, then the bond yields rise. So the bond yields rise and the stock prices fall. So there has been a massive exodus of foreign institutional investors from the Indian market because of inflation. So particularly inflation is considered as a fundamental of the economy, and if inflation is very high, there is generally a pessimism around the market, and we see less of investments or a bearish outlook on stock market.
And the volatility is unbelievable. Every day one day it's up, one day it's down, and nobody knows in which direction it is going. So careful if you're an investor. Sukrita has this question about the next RBI MPC meet. What should we expect? A heavy increase or a slight increase in rates?
So it's, as the Reserve Bank governor has already indicated, that they are going to raise, he used the term no-brainer, that it's a no-brainer that RBI is going to hike interest rates. And he also said that they had an off-cycle meeting in May, particularly for this reason, that they should not have a sudden, very huge quantum jump in repo rates in the month of June. So we should see a calibrated increase in repo rate hikes, but one doesn't actually know, because the RBI governor was also not able to answer this question, as it's a collective decision. So let's wait and watch for the MPC meeting.
Manjul Sharma, who's been a member with us for 2 months. Hello, Manjul. Thank you for being a member. Do you think Atmanirbhar Bharat program is an euphemism for import substitution of the 1970s?
Okay, so what we see here, Atmanirbhar Bharat, is different from import substitution, because here what we are also doing, especially from, if we look at the government's perspective, what the government's intent is to develop India as a market for exports also. So what government is trying to do is to incentivize not only domestic producers but also international producers to come and set up shops or factories, so that they can satisfy the domestic market as well as provide to export to international market. So it's not exactly import substitution, but it is favoring or incentivizing both producers of domestic market as well as international market to come and set up entities, factories, units in the domestic economy.
Last question, Radhika. This one is from Gulshan Gupta. It's not related to inflation, but it's more about trade. Gulshan asks, why is the India-China trade deficit increasing?
One, is political in nature, because we have imposed a lot of duties, and it's a conscious policy decision to diversify our trade relations from China to other countries. So I think that's the main reason of why the trade deficit is increasing, and that's the case with most of the countries. We are seeing that there's a diversification happening from China to non-China sources.
Mm-hmm. Thank you, Radhika. There's another question which is not very clear. This one is from Aditya, who's a new member. Aditya says, do you think how much more taxes government can go for a tax cut with elections coming in the end of the year? But we are not sure what taxes you're referring to, Aditya. Direct taxes, indirect taxes. I mean, direct taxes, we haven't seen any cuts in a very long time. So I'm sorry, we are unable to respond to that very clearly right now. Next week is the week of GDP numbers. We will be back next Friday again with Macro Sutra with Radhika. Any forecast you want to make for GDP, Radhika?
It will be around 3.5 to 4%. There will be some impact. It is interesting to see this quarter, because there will be impact of the COVID wave also, plus we will also see some initial impact of the war. So, if we look at the forecast, what economists are making, it's a big range from 3.5 to 5%. So it should be around that.
So please do tune in next Friday, same time. We will be back with Macro Sutra with Radhika, and it will very obviously be about the GDP numbers and the forecast and what else the data talks. Thank you for watching, and please tune into The Print regularly. Thank you.